Good morning, everyone. Thank you for coming to our exit planning part 2 to really talk with our trusted advisors who are going to share their expertise. We've got Think SBA, Shoreline Partners, Levitt Sachs, and PBO Advisory joining us today. A few housekeeping items. If you have questions that you'd like us to ask the panelists, please put those in the chat. And I will make sure to get your questions answered. We also will have a Q&A at the end, but feel free to just pop your questions in, and we'll get them interspersed throughout the panel presentation. This webinar is being recorded, so no need to take notes. We'll get all of the information over to you shortly after the webinar, and we'll be happy to answer any questions for you. We will have the panelists' contact information as well after the webinar, so that if you have more detailed questions about your very specific situation, you can connect with them. And so with no further ado, I would like to introduce our very esteemed panelists. Thank you so much for joining us today. Allison, if you can go to the next slide, I'd like to introduce Tim Malott with Shoreline Partners. And Tim is the managing partner and serves as the president and CEO of Shoreline's broker-dealer affiliate and Shoreline Ambrose Advisors, LLC. Since joining the firm in 1994, Tim has led numerous sale, merger, acquisition, and financing assignments across a wide array of industries. He's a former CPA and national bank president and holds 4 securities licenses. His career spans public accounting, commercial banking, and investment banking, through which he has gained knowledge and experience in nearly every industry and business sector. He oversees and works closely with the firm's managing directors on strategy and negotiations to obtain the best possible value from the market for each sell-side client. And then we have Victor Ransauer with Levitt Sachs. Victor, during his 35 years in public accounting, has honed a broad range of skills in auditing, mergers and acquisitions, as well as general business consulting services to both large and small public and private companies. He advises the firm's clients with the sale, acquisition, and divestiture of businesses with values exceeding $175 million. His skills include deal structuring and negotiation, financial reporting, research, and the design and performance of due diligence procedures. He has extensive knowledge of government contractors and the federal acquisition regulations. We also have Ryan Smith with Think SBA. And Ryan is a former banker who founded Think SBA with the goal of helping business owners and entrepreneurs expertly navigate the SBA loan application process to purchase real estate, acquire a business or franchise, or buy out a business partner. Ryan has leveraged his most trusted lender relationships to assemble a portfolio of funding sources proven to be responsive to their clients' unique borrowing needs. And last but not least, we have our own Josh Seiler with PBO Advisory Group, who's a senior finance consultant for the team. He brings over 13 years of experience as a finance consultant and auditor. Josh leads a variety of functions, including financial due diligence and quality of earnings reports, U.S. GAAP and IFRS audit readiness, budget and pro forma forecasts, technical accounting, and internal controls. With a diverse background working at a large national CPA firm, as well as smaller regional practices, Josh has exposure to publicly traded enterprises and privately held companies, including many startups. Josh has been a CPA since 2014 and holds a BS in Business Administration with an option in accounting from Cal State University, San Marcos. So welcome. We have quite an amazing group of folks here today with a wide variety of expertise. So it's going to be a very lively and energized conversation. So with that, we're going to kick this off with Tim. And we are going to really have Tim talk about what is an investment banker and what do they do?
Thanks, Fran. Great to be here. I am chuckling, though, looking at all of our pictures on that slide. You're the only one that had a coat on for the picture that still has a coat on today. So I don't know if we're just all relaxed or if things have changed since we had those pictures taken. But I noticed the four guys here have no coats on, and we all did for our pictures. So I thought kind of humorous. So I appreciate the question. The role of investment banker on the sell side transaction, which is what this is about exit planning, is we end up quarterbacking the sale process and the negotiations. I have a good friend who's a commercial real estate tenant broker, and he said his role is that acquirers all have big teams of people that manage those things, and it's the same way on the sale process. Potential acquirers of privately held companies are usually going to be much larger companies or private equity groups. They have people very experienced in M&A transactions and how to negotiate to get the best deal. Business owners don't have that. That's not their expertise. And so that's the expertise we provide. We create competition with multiple buyers to get the best value. We'll talk more about that later. We make sure information is provided at the right time and not prematurely, and it's the right information. I've got a client right now that gave a prospective buyer just their unvarnished income statements without looking at, well, are there add backs for personal expenses and other stuff? They got an offer that's a lowball offer. Well, no surprise, because the buyer doesn't even know what kind of information they should be looking at. We also protect confidentiality. We think it's really critical in a transaction. So that's what we do, is we bring all of that experience to getting the best value from the market. We work closely with our clients' other advisors, including their CPAs, and attorneys to get the best deal that they can from the market.
So, that's a really good point. Whenever you're on the sell side or buy side, it is good to have a team of professionals and experts in their field. So, Josh, talk to us a little bit about the role of the finance team on a sell side or buy side transaction, and what you do to support people like Tim on the investment banker side.
Sure. Tim said that the investment banker is the quarterback of the process, but the finance team on buy side and respectively sell side, gosh, they're like the quarterback for their own team there, because they got to lead whatever side they're telling the story for. So the finance team on a buy side, that's got to really produce the past, present, and future figures, and not just drop the P&L over like Tim was giving an example of, but actually be able to tell the story, represent it, and communicate with reliable evidence. Because we're talking about performance over multiple years. We're projecting into the future. We're talking about financial health at a point in time. So on the buy side, you often have a CFO who hopefully has been through this, who understands the nature of the dance and can actually talk through things that come up, and then some sort of controller and accounting team that can produce reports timely and accurately. And so it's not just earnings, it's like Tim said, there's add backs, there's unique items, there's personal expenses. That's the joy of running a private business, right? There might be things that are unique that come up, maybe things going through the business that we want to talk about that you don't want to impact your metrics and really your valuation at the end of the day. And so that's the buy side, and the sell side is hopefully, forensic experts that understand how to interpret and look through and really understand the nature of the industry and the business itself, so they can understand the risk when they're going to put a multiple on the earnings they're looking at, and to understand the quality of the earnings that they see.
So Tim, if your role is partly to quarterback all these professionals, when do attorneys typically get involved in a transaction? And also, really, when do CPAs get connected in to the team?
So CPAs are usually involved earlier than attorneys, it's answering the question about what kind of accounting is being done, things that we need to be able to present information to the market. We got to understand often the CPAs have a better knowledge about some of the accounting practices of the company than the CEO owner does. So we typically get introduced to CPAs early in the process. Attorneys really, when they get involved, really depends a lot on the company. For smaller companies, they tend to get involved when the letter of intent has already been received, or maybe even later in the process at a purchase agreement stage. Larger companies are often going to have their, and when I say larger, maybe 25 to 50 million or more in annual revenue. Their attorneys may be involved up front that want to have a little more control over the process in terms of NDAs that are used with prospective buyers, or if there are any issues that could get in the way in getting a transaction completed. So I'd say in our engagements, it's about 50-50 where our clients want the letter of intent to be reviewed by their attorney versus having the attorney get involved later in the process, maybe when a draft purchase agreement is reviewed, because we kind of use our 30 years and we know what needs to be in the LOI. And so it just depends in a letter of intent. Depends really on what the client wants to do.
So, Victor, maybe you can talk a little bit about the CPA's role in the exit planning process, because as Tim indicated, you guys are coming in much earlier than maybe the investment banker team or the attorney team. And of course, the finance team is tracking, hopefully, all along the way, if we've got a sophisticated finance team in place at the buy side or the sell side. But when does the CPA get looped in?
Well, normally we're involved kind of from ground zero, because the clients are talking to us about, potential deal structure, or just, I'm getting to the point where I want to take some chips off the table. I want to slow down. So I want to look for a sale in 2, 3, 5 years. And as part of that process, we start talking about if they're only a tax client, it raises questions about revenue recognition, the quality of their financial statements. So I like to say you need GAAP financial statements, not crap financial statements. Excuse my language, but it's true. We've had new clients come in, they already have the letter of intent, which is not been reviewed by an investment banker or by their attorney or by a competent CPA. So they're kind of locked in, even though it's non-binding. It becomes more difficult to negotiate those terms. But if you don't have scrubbed down financial statements that you can represent to the buyer are in accordance with generally accepted accounting principles, that's GAAP, it can create some challenges and string out the deal and potentially provide a haircut to your client, the seller.
It's a really good point. I mean, Josh and I have clients where we're looking at financials and getting them ready well ahead of time, because solid financials will drive a better business value. So with that, let's talk about driving business value on the next slide. Josh, what are some of the ways that the finance team can really enhance business value in preparation for exit planning?
Yeah, they can establish trust with all the parties through transparency. We're obviously talking about privately held businesses, so these aren't public companies where there's a lot of information out there. What's going to be offered is what the buying party actually trusts and feels comfortable going through. So they're going to rely on the finance team on the sell side to be able to produce that clear picture of where the business is, where it's been, and explain all the uniqueness, depending on the industry. Gosh, it could be a lot of unique things going through those numbers. And, Victor said it's got to be GAAP, not crap. So at the end of the day, you don't want something to get held up because now you're getting a first-time review, a first-time audit, a first-time quality of earnings, and things are just going through that are affecting your EBITDA on a normalized basis. So to enhance value, you've got to be able to have two parties that are actually closing the divide between the offer and the sale price. And then the finance team has also got to be able to explore the impacts of the sales strategy. So what kind of debt service is going to be here? Are there unique deal structures going on? Those are the things that you got to have the right players in place so you can actually walk both parties to completing the deal.
Really good point. So in your experience, Tim, do you see a lot of folks getting a formal valuation before they go to market?
So it's interesting. I've been doing this for 30 years. When I first joined one of my former partners, our first step in every engagement was to do a formal evaluation of our client. And we quickly realized that was a waste of time and our client's money, because the fair market value of any company is what a willing buyer and a willing seller will agree to. It really has nothing to do with a formal evaluation. And sometimes, and I know there may be questions here about what's the difference between an investment banker and a business broker. Business brokers will often do like a less formal valuation, and then they set a price for the client. That's what they market it at. We found that becomes a ceiling, not a floor. And nobody's going to say, hey, you said your company was worth 10 million. We think we're going to pay you 15 million, even though you told us you wanted 10 million. So our approach is and Josh mentioned it, we write a client memorandum that really just tells the story of the company. And then we market those to companies that we believe should be prospective acquirers. And then we want them to make offers to us because we create competition. We negotiate one against the other in kind of a private auction setting. One of the things my former partner, the founder of our firm, said, you never want to wake up the morning after deal closed and wonder how much money you left on the table by not really creating and maximizing competition. So that's what our process is designed to do. And that has nothing to do with a formal valuation, which has its place for gifting or tax purposes or estate planning, all of those kind of things. But it really has no value in the true market effort to sell a company at the best value.
So, I mean, what you're basically saying is, don't put any kind of a price tag on a company. Go out to market and see how you can drive value. Meaning, you don't put a specific number or set expectation out in the marketplace. You go shop and see how much you can drive that price up.
Yeah, and I mean, if you talking to probably anybody here on the panel, we can give people a general indication of where we think the multiple of EBITDA probably is for the company. And that's important because if I think a company's probably worth maybe 12 to 15 million, and the buyer says, or the owner says, I won't sell for less than 30 million, it's probably not a good engagement, because just like trying to sell your house for double what the one next door just sold for, it's really not something that's worth anybody's time and effort. And so we can give a hand grenade close enough view as to where the value may be. So then a business owner can say, yeah, that makes sense. Let's go ahead.
So Victor, when you're working with clients, are you helping them both on the personal tax planning side and the exit planning side to really talk about this thing that Tim is saying, is where is the setting expectation and also driving the plan towards here's the dollars that individual could potentially need when it's a private transaction?
Yeah, we do extensive modeling projections to look at what the anticipated gain is going to be at the entity level and then at the owner level. And depending on the entity type and the structure, the deal structure, all of those have direct impact on the amount of tax you're going to be paying. But we'll run at different scenarios. So our client has a very good idea. If it's an X dollar sales price, here's how much cash you're going to walk away from. And Tim's right. We've modeled a number of transactions where our clients had an expectation of something that was unreasonable. The investment banker comes in, brings everybody back down to reality. We rerun the numbers, and it's not enough for them. They decide that there's not enough bottom line for them to close, basically retire. So that's part of the process. But yeah, we extensive modeling. You have to know what you're getting into.
And I think, just to jump in there, I think, and Josh mentioned it as well, that's the right opportunity for whether it's CPAs or the finance team, as Josh described, or somebody like our firm, to help the business owner say, if I need 20 million and I'm probably only worth 10 million today, what do I need to do to build value to get that? What do I need to change, or how long will it take me? We've got a presentation that I'd be happy to provide to anybody if they'd like to see it. It's called 10 Do's and 10 Don'ts to Build Value in a Privately Held Company. It's based on 30 years of M&A transactions, seeing where things that companies had implemented that really built value, and conversely, things they should have done that they didn't that got in the way of a higher value. So those are things that good advisors can help companies know. What do I need to do to double my value in the next 3 to 5 years, maybe, if that's their exit plan?
Yeah, that is huge, and we talk to privately held companies all the time, and frankly, we should always be looking at the end and backing into what is it that we need and planning for that, and that's where the finance team really comes into play. If we're doing our jobs, we're getting our clients ready years before, so that when they come to you, Tim, and when they come to you, Victor, we've got a really nice runway and opportunity to drive value. So, and tax is a huge component of that because of deal company structure, et cetera. And so a lot of our clients, some of the folks on the panel are incorporated in California and some are not. So what happens, Victor, if a company is incorporated in another state other than California? What does that tax implication look like?
It really comes down to the state of incorporation doesn't drive the tax. It is the state you're doing business in. Where's the income being sourced? Where's the company located? Where are the owners located? That's going to drive the tax result. We met with, the reason I'm smiling, new client last week, and it was like, we're incorporated in Delaware. They're looking at a transaction probably 3 years down the line. So we don't have to worry about California taxes. And it's like, no, your income source here. There's things we can do to minimize that 13.3% California tax. And in certain situations, if people follow the rules and do it correctly, it requires some hoop jumping, but you can avoid California taxes and not have to move out of state. So, but that's where the deal structure becomes very, very critical. And with the investment banker being able to line up how the transaction, how the deal is being structured. And that comes down to the investment banker, their ability to negotiate the deal. Critical.
And Ryan, so does deal structure impact the ability for financing?
Absolutely. So deal structure, in fact, is imperative to financing because what lenders want to see is that the seller and the buyer have a structure that can close. And I always tell my buyers that what we're really focused on, even from the beginning, is closing the transaction. So that means structuring it for success before we ever even apply for the loan. And especially on SBA loans, because as I represent buyers in the lower middle market, enterprise value companies under 15 million, there are specific rules and guidelines through the SBA financing product that must be there, or else the whole transaction is ineligible. For example, seller notes are acceptable in an SBA loan transaction. However, earnouts are not. However, we can structure a seller note to look like or be similar to an earnout. And so that's where when we structure for an SBA loan transaction, we want to make sure that it's eligible so that we don't get to the end, obviously, and then the whole deal blows up because the transaction was ineligible from the beginning.
So Tim, when you're going out to market and you're getting through a deal, do you work with the if the buyer is financing, do you work with someone like Ryan to make sure the deal structure is going to work for getting the deal done?
Yeah, and that typically will happen more with smaller companies, as Ryan mentioned, probably deal values 10 million and under, where that maybe the buyer needs SBA financing. Where we're representing the seller, typically we're not involved in the financing. If it's a larger company or if the acquisition is being done by a larger strategic company or private equity group, they have their own financing sources. But I've specifically worked with Ryan in probably 3 or 4 transactions over the last couple of years, and it's been very interactive about how, as you mentioned, how do we structure the seller note so it looks and quacks like an earnout, but it's not called an earnout, to get the deal done so it makes sense to both entities.
And we've talked a little bit about, mostly about selling a company to another entity, but oftentimes we're seeing, and maybe you don't see this, Tim, on the investment bank side, but Victor and Ryan, you probably see a lot of partner buyouts, so or employees, senior leadership teams buying out success and being the successors of a company. So how, Ryan, do you recommend that when there's a partner buyout or an employee buyout that we make sure we structure deals appropriately?
So let me talk about the partner buyout. So through the SBA financing platform, partner buyouts are able to acquire the remaining equity in a business for no money down. So that typically makes the transactions simple. We have an expert, obviously, who's already a partner. They're simply acquiring the remaining equity of the business they already own and operate. And then what that means is that the exiting partners are made whole upon their exit, so everybody's happy. However, when we have what I call a key employee acquisition, the most important, as you have already all said, preparation, right? So what I run into a lot of times is where the key employee has been targeted and identified as the successor. However, they haven't prepared, so they do not have the necessary 10% equity injection to transact and close the loan. And so what ends up happening is we have to go to the seller to structure that seller note in a way that contributes to the buyer's equity injection. And in all honesty, I receive a lot of calls from key employees who are not prepared. They do not have the equity injection. And then what ends up happening is that the seller doesn't want to be in a subordinate position to the SBA. So what they do is they end up financing that transaction entirely for their key employee.
Yeah,
and Ryan, I asked a question there, Ryan. You told me sometime within the last year, maybe there was a change in the SBA regs that would allow a selling partner to keep a little ownership stake. So maybe if the key employee doesn't have the funds or the wherewithal to buy everything all at once, they can buy less than 100% of what that exiting owner has. Is that accurate?
Yeah, absolutely. So now the SBA allows what are called partial changes of ownership, where that key employee, and I'm transacting on a few of those right now, where the key employee can buy into the business. And if they buy into the business more than 80%, that means that, again, just like a partner buyout, there is not an equity injection required. And if the seller, the current owner, owns less than 20% of the business post-close of the transaction, they also don't have to guarantee. So it's really nice, right? Because the seller can take some risk off the table, put some money in their pocket, but they could still continue to own and operate the business. And also what that does is it avoids that SBA rule that requires a seller in a 100% buyout transaction exit the business before 12 months. Now they can stay on in perpetuity because they are an existing owner. They've been the owner, and that rule, therefore, is no longer a part of the transaction.
And that selling owner that now owns 15% can maybe get that second bite of the apple, right? When sells in 5 or 6 years.
Yeah. And Victor, you probably see this.
Well,
often.
I've seen. We normally are seeing it where you have two or more owners in a business, and one owner wants to exit. The last one that comes to mind, it was about a $30 million buyout of a 49% owner. And we structured it such that the corporation bought back the equity interest. So our remaining client then owned 100%, but it created a unique situation from a tax structuring standpoint to provide the corporation with a significant deduction. It's a concept called personal goodwill, and it was, you got to get an appraisal, make sure you have your I's dotted and T's crossed. But we were able, out of that $30 million, which normally would have zero positive tax impact, to carve out about 18 million of it as personal goodwill, which gets deducted over 15 years. So a big plus up to the corporation and the remaining owner.
Fran, I'll also mention too.
The big takeaway is don't do these things without talking to your professionals. Yeah, don't start having these conversations until you're having some dialogue with all your team, right? Tim?
Yeah, and Fran, a lot of people don't recognize that there are fundings even for larger transactions where like a private equity group will come in as a minority owner to provide the funds to buy out a partner that wants to exit. So that's really just another sell side engagement for less than 100% of the company. So there are funds available to even do those larger buyouts.
Sorry, I'm on mute. All right, so we're going to move on to the next slide and really talk about how, Tim, do you go about finding successors and buyers for a business? You kind of touched on it with, creating the story, but tell us a little bit about your approach.
So when we have a new client, we spend 3 or 4 hours in a pretty intense discussion. I've learned from my, as I say, recovering CPA days and my banking days and my M&A days that we go line by line through their income statement, balance sheet, because if we understand how revenue is generated, who the customers are, and how do they bill, and how do they market, we understand everything about revenue, we really gain a deep understanding of the client and going through all of those things. After that preparation meeting, then we kind of have a brainstorming meeting back here at our office to talk about what are the criteria of companies that should be interested in our client. Size, industry, profitability, geography, management, all of those kind of things. And then we start every engagement with a clean slate. We then research the market to identify companies, both strategic companies as well as private equity groups that we believe should be interested in acquiring our client. They may or may not be looking for an acquisition, but our job is to market to them, show them that they should be interested in our client, and then try to get as many people interested as we can. One of the things, and again, I think it's the benefit of using somebody outside as opposed to an owner. In 30 years where we're brought in to sell one of our clients, like to market to a broad group of acquirers that we've identified through our research, we've never once sold one of our clients to somebody our client thought would be the buyer, which I find fascinating because it says business owners tend to think in a narrow stream of the industry they work in, and often that's the least value because all those people are doing is generally buying market share, as opposed to companies that maybe are in an ancillary industry where they can sell more to our clients' customers, or sell the acquisitions products or services to their customers. There's a bigger strategic value gain. So we try to think outside the box creatively on who's going to benefit the most from this acquisition, because the best value is going to be with somebody that needs our client as opposed to just somebody that wants our client.
Wow, that's extraordinary. That's the statistic. So once you go out to market, and let's just say you have a lot of LOIs that you're looking at, which is a nice problem to have. This is really a question for Ryan. Should the seller look at the buyers and their strategy for financing a deal as part of the consideration for weighing the LOIs? I'd love to hear what Ryan and Tim have to say about that.
Go ahead, Ryan.
I'm going to keep it short and sweet, and then I'll let Tim expand on it. But the number one thing I would say is absolutely. And the correlation that I've seen is that when a buyer, again, I'm speaking lower middle market, when a buyer has direct or transferable experience in the industry the seller is an expert in, it is highly likely, as long as, again, all the other deal points are there, that transaction will close. The further away that a buyer gets from having that expertise, the higher the likelihood that the transaction doesn't go anywhere. Obviously, that dovetails directly into financing, but what I also see in that is that the buyer is just not able to get over the hump with the seller or the the lender to get that transaction executed.
Yeah, and I'll add that in LOIs we get for our clients, I'd say it's about 50-50, where about half of them have a financing contingency that basically says, okay, here's the general terms with which we'll buy the company, but it's subject to us getting approval for financing for the transaction. About half of them, where it's a much larger company, private equity group, they already know they've got the financing lined up, and so assuming things check out in due diligence, there's no financing contingency. If there is a financing contingency, though, for the deal to close, that's when we're going to dig a little deeper and say, okay, well, you got to tell us what that is, because generally they're going to want to lock up our client for 90 to 120 days. And if we don't believe they're really going to be able to get the financing, we may not want to go forward with that buyer. We may want to talk to somebody else that's interested, or ask them,
Yeah.
or we may give them like 30 days. You got to remove the financing contingency within 30 or 45 days, or otherwise the LOI is terminated. There's different ways to approach it, but if there's a financing contingency, it's a big deal we need to think about.
Yeah, I'd
That's a
like to
really,
add, we
go
had
ahead.
sorry, Fran. No, the if you're the seller, you have to still do your own due diligence on the buyer. It was a large transaction, didn't close. I met all hands meeting, no investment banker involved, which is one of the problems. They had a great attorney, M&A attorney, CPAs were on board, but no investment banker, who I think is a front line of defense as to, is the buyer real? Do they have the financial wherewithal? And I recommended, since they didn't have an investment banker, didn't know the potential buyer, that we have a private investigative firm we use to do background checks and see if anything is unruly and people you don't want to actually do business with. They chose not to, and about 9 months later, hundreds of thousands in legal fees. They finally took my advice, ran a background check. The buyer wasn't real. It was basically a sham. They were trying to get technology, and well, they came to me and said, you could say you told us so. And I said, I would never do that. But that's where, had a Tim Malott been involved, that deal would have gotten scrubbed down and never gotten that far down the line.
Wow. Yeah, there's so many things that can happen. I mean, Josh and I work on some clients where, and maybe you see this, Tim. So Josh, maybe you can speak to, when we're working with private equity that aren't experts in the field. They're the money guys, but they're not experts in the field. They have the funding sources, but when you get into due diligence, you look under the hood, and it's a fascinating process. We'll get into that in a little bit, because we're going to talk about due diligence in a little bit. So why don't we go to the next slide and talk about funding? And we're gonna kick this off. We talked a little bit about the risk of a deal having an earnout. And, Ryan explained that there are ways that we can structure a deal so that we can manage our financing sources and manage the earnout. So what, Ryan, are steps a seller can take to help a buyer qualify for financing if they're financing a deal?
So the first thing the seller needs to realize is that they are still the experts in the business, and that it is very important for them to deliver to the buyer, to the lender, a clean and accurate financial statement package. That's the first thing that they can do. And then the second thing is to realize, and I need to emphasize this because I run into a lot of sellers who treat the buying of their business as if it's only on the buyer, the financing as if it's only on the buyer. And so they hand over the financial package, let's say it's good or not good, and then they go away. And then they think it's an annoyance anytime they're contacted with a question or clarification that's needed by either the buyer or the lender. So I would say that they need to hunker down, understand that they're a vital part of the transaction, and to be ready with supporting documents. So for example, I'm in a transaction right now where it's an add back reliant transaction. And so the lender and the buyer, myself, we're going to the seller and we're saying, hey, that's great. You have a Padre suite. We're all happy about that. Show us those receipts so that we can add that $17,000 back. And he's saying, well, him and hawing, and well, do you want to sell the business or not? We have a highly qualified buyer. The lender's in love with this buyer. We're ready to go. We just need to validate those personal expenses.
Very good point. Josh, you've done a few of these deals. What are some of the, when we're preparing to go into an exit planning, what are some of the things that you see in financial statements that need to be addressed, corrected, modified? And let's also talk about add backs a little bit.
Yeah, it's all about normalizing earnings. So one of the most common things that we see is just how the owner's pay is structured. And is that truly an add back, a deduction from adjustment to EBITDA? So, we've recently seen one where C Corp chose to have low salary, high bonuses. And so coming up with, well, what's the true wage? Are these owners going to stay on? They're very skilled people who need to be in the business. So it was really starting to beg the question, should we have a comp study? Should we understand the market of the service that these owners are actually performing? How do we bifurcate between what are they doing at a day-to-day level versus what's the value and reward of them being an investor versus an employee? So understanding the roles are there. Other things we see are, is this business trying to look more profitable in the few years running up to sale by just really going short on key departments? Maybe I'm biased, but you see a slim finance team. We see all the nooks and crannies and things that need shoring up. And, you realize the team doesn't really have a full-time biz. It doesn't have a finance department, outsourced bookkeeper, 10, 20 hours a week. So it's coming up with what you think the business is actually going to incur in the future, because you don't want to buy a business at its peak, right? And then realize you have to staff it up with all sorts of experts and other team members. So normalizing that. Are they paying rent to the owner? Does the owner own the facility? Because the rate of that rent, is it market? What's their structure? Maybe they're overpaying, maybe they're underpaying. What's the agreements in place? And that dovetails to the whole legal side of the diligence process, just to, see beyond the numbers, what's the commitment and what are the true costs going to be when you take ownership and take out the previous owner's agreements.
So to quote Victor, if it's not GAAP, it's crap, which is, I love that new saying. Josh, talk a little bit about revenue recognition and the importance of that in certain business models, because it is a really important piece of having good financial statements.
Yeah, RevRec, that's the fun part for me, right? So you come in and depending on the savviness of the seller, they always think billings are revenue. They might think cash collections are revenue. But at the end of the day, we got to understand what's the true gap. We got a lot of decades, centuries into developing our standards and rules for reasons. So we want to make sure that we really know how the company is performing based on the rules, not just based on the mechanisms of sending invoices and collecting money. Nobody wants to walk into a business and realize that they actually got a lot of deferred revenue. They got a lot of things that they got to perform. Maybe the most recent contracts are a couple dogs they're just trying to cycle through. So understanding the nature of the business, understanding the accounting literature, ASC 606, that's contracts with customers, that's going to drive most RevRec in today's world. And so, the seller may think that they got this business that's doing great because a lot of money came in the bank, but you come in and you realize that it was just front loaded. Maybe it's a long-term construction contract or a consulting arrangement that has some milestones that operationally haven't been met. So the timing of recognition, that's the top line of your earnings, right? So understanding the timing and actually getting that correct and seeing how that's going to flow down to the bottom, that's extraordinarily important. Because at the end of the day, if you go through an audit or quality of earnings and it holds up what was represented, that's all going to shoot back into the valuation eventually. So getting RevRec correctly is step one of understanding the P&L in an acquisition.
Yeah.
So Tim, when you have that, go ahead, Victor, go ahead.
No, I wanted to add that if you look at where post acquisition, where there's a bust and people are going back against withholds and that, normally the errors, and if you look at what happens with SEC regulated companies, the areas that people get beat up for is revenue recognition. They're not doing it right. Seller after the fact figures out, and they missed it in due diligence, figures out that they're doing it wrong, and then all of a sudden you have a problem. So yeah, RevRec is number one.
And so Tim, do you walk through with your clients understanding their financial statements, their practices. So for instance, do they do a WIP, or how are they recognizing their contracts over the period of time? Is that part of your role when you're meeting with them?
Yeah, absolutely. And in 30 years, we've only had 3 transactions after a letter of intent's been signed that didn't close. So we got a real reputation for getting deals closed. And part of the reason for that is how in depth we go in that preparation meetings. We don't want any surprises when we get to due diligence. Those will kill a deal faster than anything else. So we talk about all this kind of thing: revenue recognition, timing. I've got a client right now that bills as services are provided, but then the payment for their third-party outsourced consultants gets booked a month or 2 months later when the money is actually received from the client. So timing, it's the matching principle in accounting, making sure that revenue is matched up and from a recording standpoint with the expenses. Those are all important. So we talk about all that stuff. Because I found that most things can be fixed if we know about them soon enough. If we know there's a revenue recognition issue, usually before we go out to market even, or while we're out in market, we can fix those working with their other advisors and what we can do internally. And then there's not an issue when an offer is made, because now we know the financials that the buyer has that they're making the offer based on are going to stand up to the buyer's due diligence review.
So in that process, as you're reviewing financials, et cetera, and maybe potentially working with Ryan, Ryan, give us a little bit of understanding about how SBA lenders specifically are deriving cash available to service debt, because as we're looking at financial statements, it's an important thing for us to understand.
So the first thing to understand is that the SBA is obviously a federal government program. So what they're relying on primarily are tax returns. And so those tax returns are obviously locked in, and they're going to prioritize the last fiscal year tax return more heavily than the periods before that. So for example, we're in 2024. What I do now is I go straight to 2023. We all know that sellers like to mitigate their taxes, and so that could be a challenge. And so what I will do as a broker, someone who's been in banking for 20 years now, is I will take the tax returns, I will add back obviously depreciation, interest, officer comp to the net income. But then what I can do is go to, for example, an SDE worksheet, seller discretionary earnings worksheet, and then I will pick those line items that I know that the lender will accept. What lenders typically will not accept: meals and entertainment, travel, I've had concerts, all different types of things. And the reason is because it's very difficult, even in a QOE scenario, to differentiate, was that a business expense or was that a personal expense? Was it necessary? What was the true thought behind that expense?
So really, your process and the financing is very process than when we're doing our add backs to EBITDA to try and drive value. So there's a bit of give and take there, I'm assuming. Is that right, Tim?
Yeah, absolutely. And again, when we come up with the add backs that we want to make to get to EBITDA, we want to be highly confident they're going to stand up to the buyer's due diligence review. So a little gray is okay, but really gray or too much into the other side is not okay. We have to know, as Ryan mentioned, we got to know our clients got receipts and can justify them so that the buyer is going to have confidence. Because I found all the kind of stuff we're talking about where information is provided either to the lender or to a buyer, the greater credibility means the higher value and the higher chance it's going to get done. If a buyer or a lender starts to think that there's some smoke in here and mirrors, they're going to back away quickly because they're going to wonder, well, what else don't I know? What else do I think is being miscommunicated to me? So credibility is just critical in getting the right deal done.
Yeah, that's one of the challenges. If a client is only doing taxes, you have a tax return, there is a huge difference, two different realities: GAAP accounting, generally accepted accounting principles, and tax basis. You could be cash for tax, which is completely different than what you're doing if you're preparing financial statements in accordance with GAAP. So that's where, if they're not doing a review or an audit, Tim's magic comes in and basically converts that so a potential buyer can look at it and make a determination what is earnings or bottom line under generally accepted accounting principles. I'm one who promotes do a review at a minimum to get yourself ready for sale. Audit's better. It lends credibility to the financial statements and the ability to get a deal done.
Yeah, and Ryan, you mentioned quality of earnings reports. Josh, tell us a little bit about what is that?
Yeah, quality of earnings report is a communication tool. So if you just think about a deal working backwards from the consideration transferred between the parties, before that, there's obviously a valuation, right? And to come up with what should be in that valuation, you have to have a reliable figure of earnings. So the quality of earnings report is just that. It's a deliverable. It's a report that you read that goes top to bottom through the financials and produces EBITDA in different sort of metrics, different sort of lines. So it's a known GAAP report, but ideally there's also some audited or reviewed financials that help lend or render more confidence in it. But the quality of earnings is going to go through and disclose unique and material things about the business. And it's going to bring a lot of things to light and give the reader of those financials a higher level of confidence. And so, you go through your rev reg, you go through business costs, you get to an EBITDA, and then you're going to start to see all these adjustments, these add backs we've been talking about. You get these different sort of rows of EBITDA, whether it's normalized, it's diligence. I've seen some creative stuff out of WeWork, came up with their own idea of community adjustments, community adjusted EBITDA. So you're going to see how the seller sort of views their financials versus how the buyer and their diligence team are going to come in. And then it'll show financial health, net working capital. It's going to facilitate. Most deals are cash-free, debt-free. So there will be some plus there. And you get to see the ins and outs that are dictating the inputs. So what's going to go into the valuation.
And we're seeing a lot more desire and request for quality of earnings reports. Are you, Victor and Tim and Brian, also seeing that, or is that just, is there a trend there, or is it just an anomaly for us?
Yeah, I think as somebody's heading down the path of selling their business, if the seller hasn't done their own one-off quality of earnings, the buyer's definitely going to do one, even with an auditor review.
Yeah, we see that in almost every transaction today, where the buyer is going to have their own firm do a quality of earnings. Think about it, it's like if you're selling a house. It's okay if the owner of the house gets a valuation or appraisal done, but the buyer is always going to get their own done to support, because that you can have it a value and then another value, and so the buyer typically will want to have their own quality of earnings report done, and it's worse than a colonoscopy. That's what I tell our clients when it's going to happen. So just be prepared that, and Victor, this, a quality of earnings report looks way deeper than even a financial statement audit does. They look at,
absolutely,
they trace the cash from the beginning of the year to the end of the year, and revenue should have generated cash. And these expenses without, and can they trace all of that? It's really in depth and detailed.
Yeah, and Josh is doing a bunch of them, so we're going to start to use that phrase.
The chronological exam, yep.
When we ask for all of the, the supporting documentation, their eyes glaze over. Ryan, is SBA requiring Q of E's?
So it's interesting because I would say that, let's say pre-pandemic, QOEs were not something that were necessarily a part of an SBA transaction. But what we've seen post-pandemic especially is this ETA movement, entrepreneurship through acquisition. There are several Ivy League campuses that now have an ETA department, and they hold conferences. So we have Ivy League and private equity individuals coming into what we call the SMB market, the small middle market business market, and they are increasingly ordering quality of earnings. Number one, because that's what they're used to. Number two, because they understand that spending, for example, I have a client of mine, we're helping him right now acquire and roll up landscaping business. He comes from Colombia. He spent $25,000 on a quality of earnings report that didn't go through. Ultimately, he decided to kill the deal. A lot of small middle market business owners or entrepreneurs would be very disappointed. And he brushed it off. He simply said, you know what, 25,000 could have saved me 2 million in default. And so that's the attitude a lot of these more sophisticated buyers have coming down to the lower middle market.
Yeah, it makes a lot of sense. I mean, if I were investing dollars, I would get a QV. It's a good process for due diligence in preparing for any sort of transaction. So, Josh, talk a little bit about some of the experience you've had on financial due diligence, and what does that process look like when we're representing clients?
Yeah, it looks like the SWAT team, just like swinging into the building. And so I think the example given earlier with the colonoscopy, I think it's a bit more violent though. It's I'm kidding, but at the end of the day, I think it's the most important part of the diligence process. I'm a bit biased, but buyers could come and look at legal, they're going to look at operational, general environment, but financial due diligence, that's the core where all the material considerations are come to light. It's a deep investigation into the company's financials that it's even more than just the audit. They're trying to uncover the true health, the true performance, the true projections. So it's going to be a bit more functional, a bit more creative. They're going to look into questions like, are the numbers sustainable? What's recurring revenue versus what's one-off revenue? What obligations might be hidden? Are there embedded things into these contracts that we're inheriting? They're just going to figure out all the unique things that actually drive business. And like I talked about earlier, with what's understaffed, what are the costs that are missing, what corners have been cut to produce a higher earnings multiple so they could sell high. And so what are we really taking control of is what the financial due diligence is going to look like. So if you don't have an audit, and you go in that quality of earnings, it's just going to uncover more things to talk about. And, it's the pace of the deal that's going to dictate if it gets done. So the more information you figure out faster, the better.
Yeah,
what's really fascinating is that we're working with some private equity groups right now. And, we do a pretty good job on due diligence on the finance side. Less due diligence on the human resource and the human capital side. And as we all know, people are running a lot of these businesses and making them work. And so we're being a little bit creative and innovative in understanding the human capital resources in preparing for deals so that, we are wise and understand a smooth transition of the human capital, because it's so critical to the success of a deal post transaction, right? So we're starting to really dig into that with some transactions, and we'll have our HR team talk about that on another webinar altogether. So Victor, tell us a little bit about your experience with due diligence.
Yeah, it is a colonoscopy. Kim hit it right on the head. The key items there, one, understanding the financial statements. So it's a quality product, no warts, no hairs. RevRec, once again, is a primary focus. But the other things I've seen in due diligence that can cause a hiccup to the deal, your attorney, the seller's attorney, will set up a data room, and the client will upload all the documents being requested by the buyer. For key documents or contracts, have the attorney spend the money, have the attorneys review those, because there are times when there's little landmines in there, like a side deal, which I had never seen before. One client was going through it and no one knew about it. We didn't know about it as the auditors and tax firm, and the attorneys didn't know about it. And it cratered the deal. It was something that had huge tax ramifications. It was a major problem because people were trying to play hide the ball. So that due diligence process, I can't emphasize how important it is, and to have your legal team review it before you ship it off or give the thumbs up to have those documents go to the buyer. You want to know what's what you're giving them, because the price, once you get you're negotiating the deal, a price is set. It's not going to go up. If they find chinks in the armor, they're going to drive that price down. They're going to look for whatever mechanism they can to maybe drop the transaction price. So no, it's a big deal.
You're so right. I had a deal, and we had reviewed the agreements prior to loading them into the data room, and we had a clause in the lease which was not favorable to the buyer. So we addressed it up front and said, we think we can get this fixed, and we're able to get the deal through because we were proactive instead of it being a big surprise to everyone. Tim, do you see other things that blow up deals in the due diligence process?
Yeah, I think the numbers 1 through 5 exist because due diligence will typically take around 60 days, give or take, if it's managed right. The number one thing that'll either kill a deal or kill the value is declining revenue and profitability. So our clients always say, what should we be doing while you're running this sale process? And we say, hit your numbers. Don't take your eye off the ball. Keep selling, bring new customers in, make the company continue to perform as effectively as possible. So I think in terms of what can kill deals, that's probably 1 through 5. And then number 6 is overly high concentrations, because those rent risks to a buyer. And probably that would be anything that's maybe over 30% of revenue, 30% of maybe a sole source supplier. So, I call it the Costco opportunity. Somebody gets a chance to sell to one customer that's going to pay them great, but it's going to end up being 50% of revenue. That's okay, but just realize there's not a lot of sustainable value from that, because the buyer doesn't know if it's going to continue, and Costco can shut you off tomorrow. So keep all your costs variable and recognize that that's not a value contributor. So those are probably the 2 things. The other thing in today's world, in the last 24 months, we've had 3 transactions get delayed due to PAGA claims. Yeah. And anybody operating in California should know what PAGA claims are. Our legislature just passed some stuff that took effect July 1st that will make them better, but they're still out there. Buyers won't close while there's a PAGA claim pending. So that's a big issue in today's world.
Yeah, and again, a really important reason why we should be doing our human resource compliance checklist before we go out to market, so that we really have our I's dotted and our T's crossed. That's a really good point. And it's a good point to talk about. We need to keep running our businesses as we're going out to market. And that's why it's so helpful to have a team of experts like you all facilitating that process, so we can continue to run our businesses, because we have to run our businesses to have value in them. And it's hard to go out to market with that by yourself and run your business at the same time. It's a full-time job, which we leave to you all as the experts. So I cannot believe it. It's 10:03. We went a little over time. I want to thank all of you so much for joining us, and thank you for the attendees. We will make this available to all of you, the recording available and the contact information available. Tim mentioned the 10 do's and don'ts for going to market. Please connect with him directly, and he'll get that over to you so you can have a conversation. And if you have any other deeper dive questions, please feel free to reach out to the panelists directly. And we really appreciate your time today. Thank you all, and enjoy your day.
Thanks, Fran.
Thanks, Fran.
Bye.
Bye.
Thanks, everybody.